And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's 6:06 as we get this Hump Day edition, kind of underway here and, getting into the month of August. It's hot. And, the kids are all complaining about going back to school, and it's August in Texas. So there you go. It's just where we are right now. Danny Ratliff joining me this morning as well, because it is, of course, as always on Wednesdays, we get into a little bit of the financial planning stuff as well. Interesting stories out this morning, though, as we kind of kick off the day. The eviction moratorium ban, right? So we have to go back a little bit here into last year, and following the shutdown of the economy, of course, people didn't have jobs. The CDC passed a law that basically, or so to say, passed a law because it's not really true. They passed a ban that says, landlords can't kick their tenants out of houses being rented. And so, this was kind of a assistance for people without jobs, and of course, trying to support people so they could stay in their homes that they're renting. And this was deemed to be a temporary measure that's now gotten extended several times here as this kind of pandemic thing goes on. So just yesterday, of course, right at the end of July, that eviction moratorium was expired. And so for a couple of days here, there was a lot of concern about people being evicted from homes. And of course, yesterday, the CDC recommended extending that moratorium through the 3rd of October. Now, this is likely going to get challenged in court. It is non-constitutional, violates contract law on multiple levels, but by the time it actually gets to court, gets heard in court, we'll be past the October 3rd deadline. So again, it's going to give a reprieve to renters in the short term. Now, here's a couple of things about the moratorium, though, that we need to think about as individuals, right? So first of all, there's $43 billion of assistance that we use debt to fund that is designed for renters to stay in their homes. So we're going to give people money to pay their rent. Okay, now it's gotten hung up in a lot of states. It hasn't gotten distributed yet, but that money is sitting there ready to be distributed. So now we have this ban in place, and we know the typical habits of individuals. If we give them money and there's not an immediate demand for that money, it gets spent on other stuff. That's just normal behavior of spending by people, right? Give me money, I'm going to spend it. And because, one of the problems with all of these bailouts that we do is we don't direct the bailout money exactly to where it's supposed to go. We just say, here's money for you to go deal with these problems, and they say, well, I've got all this money now and I don't have to pay rent, so instead of paying my rent, even though I've got all these stimulus checks and everything else coming in, I'm going to spend the money on other stuff. And so we saw these outsized booms in the economy of people buying all kinds of stuff, but rent wasn't getting paid, other things weren't getting done. So, problems with providing government stimulus, taxpayer money to people to spend, it needs to be directed. This money can only be used for mortgage payments, rent payments, whatever it is. That's all you can use this money for. And in fact, we're going to direct it directly to your landlord. So give us the name of your landlord. We'll send the rent check directly to them. That would be the way to do it. However, that's not the way it's done. That's not the way we do it here. When we do it fast, we don't think about these things, and so we just pass these laws. Okay, but here's the other problems. The eviction moratorium, while in its nature is intended to be a good thing, and not arguing the point, right? A lot of people without jobs, they need some help. I'm not opposed to that at all. The problem, though, becomes two things. One is that the economy is based upon contract law. You entered into a contractual agreement with an individual to pay a mortgage payment, to pay a rent payment, whatever it is. Ever since the financial crisis, we have continued to come back and violate contract law on a variety of levels, right? People didn't have to pay mortgage payments. People don't have to pay rent payments, whatever it is. We violate these contracts. One of the key factors of the strength of the U.S. economy and one of the key factors behind capitalism is contract law, the rule of law. And why is that so important? It is so important for an economy to have that rule of law in place because that's why people will come to your country to conduct business. If they feel like they have the ability to do business or to invest into your country and not have the government come along and take all your money away from you at some point, then that's going to attract more capital. It makes the country more prosperous. And the rule of law in the United States is one of the primary keys that made the United States the most prosperous country in the world, because there was a fair and equitable base in which to conduct business, and there was recourse against the violation of contract law in the U.S. The reason that other countries don't attract lots of capital and have prospering economies is because of the lack of rule of law. Nigeria, African countries, others where they're ruled by dictatorships, etc. And then one day you've got money invested there. Malaysia was a good example of this. One day people were investing in the country of Malaysia and the government said, you know what, we're just going to take all that capital. Right? So it happens, right? And so the rule of law is very important. And so when you start to violate the rule of law, and contract law in particular, it undermines the very premise of capitalism in the economy. Now, the second problem, though, is that while we're trying to bail out the renters, we're not thinking about the landlords. And there's this idea, I guess, in government somewhere, that landlords are all these big fat rich pigs sitting around in big piles of gold coins, you know, like Scrooge McDuck swimming around in their saves of gold coins. That's not who landlords are. The vast majority of landlords in this country, yes, there are some big landlords in this country. BlackRock's been buying tons of houses and renting them out, etc. Sure, they can afford to not get their rent. But a lot of landlords in this country are people just like you and I and Danny and others, right? We've got one house, two houses, three houses that we depend on for that income to bank the mortgage payment, to pay the taxes, and to give me a little bit of livable income in my retirement years, right? We buy these rental properties as a base of creating passive income and passive wealth for my family. But now those individuals who, in a lot of cases, don't have a lot of excess capital, the majority of their living income comes from their rental properties, as an example, or their job. They're now having to make up for those mortgage payments, rent payment, tax payments. All the costs, the maintenance, the upkeep, etc., is all having to get paid. In fact, the landlords are still having to maintain the properties, upkeep the properties, pay the taxes on the properties, despite the fact they're not getting any rental income coming in from the renters. And they can't expel the renter to get somebody in that will pay the rent. So this isn't just a simple one effect here that, hey, we're just going to bail out renters by not allowing that, or by telling them that they don't have to pay rent. And if we give them money to pay the rent because of the renter assistance programs, it doesn't mean the money's going to get from the renter to the actual landlord, because the renter doesn't have to pay rent now until October the 3rd at this point. And that's just assuming that we don't extend it again. But here's the problem with this, is that every time we get to this point of expiration, what do? We extend it. Now we're teaching renters that don't worry about paying rent, because when we get to that point that you have to pay rent, what we're going to do, we'll just extend it again. So this is really creating a very slippery slope in the rental markets as well as for the homeowners markets, because again, at some point here, and as not surprising, we're already starting to see inventories come up. If landlords can't collect the rent, here's the problem. The landlords can't collect the rent. They'll sell the house. And with house prices at all-time highs, this is a great time to just dump those rental properties, get out of that whole mess, and start over when things get straightened out. Be right back after the break with Danny Ratliff, right here on The Real Investment Show.
Something happening and it's usually quite loud. Our mom, she's so house proud. Nothing ever so.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hey, do it now.
And welcome back to the show this morning. Brent, did you know that every year 10 people get eaten by sharks?
I did not know that.
It's we worry about getting eaten by sharks a lot. My daughter, we my whole family, we like to scuba dive, and so about once a year we go diving somewhere. And I was asking her the other day, there was a shark movie on television, and I said, "Hey, let's watch this movie." You know, it wasn't Jaws. It was one. You know, it was like, I can't remember the name of it, but anyway,
some knockoff Jaws movie.
It was some knockoff Jaws movie. I said, "Let's watch the movie." She goes, "Do you ever want me to go scuba diving again?" But you know what animal she does like?
What?
Cows. She loves cows. Cows.
Really?
Yeah. She doesn't realize that 100 people die every year from getting stepped on by cows. 10 times the rate of a shark bite.
Who knew?
But she likes cows.
Yeah.
So we're gonna start watching cow movies.
Yeah, but I think you know where cows are. You can put yourself in that situation where it's a shark. It's a little different, Lance. Come on.
Yeah, there's been more than one occasion we've been diving and like you look behind you and there's a shark trailing behind you. That's happened like 3 times while we're diving. So it's like just sit very still, let it pass.
Being trolled by a shark.
Yes, more than once.
Yeah.
So anyway,
Lance, with your luck on vacations, you should probably stop that.
Hey, you know what? My luck on vacations only happens when I ski. When I do anything else, it's fine. We never have a lick of trouble, right? When we go diving, have never had a bit of problem. Traveling, flying, sickness, nothing.
Knock on Formica.
Yeah.
Right.
But when it comes to skiing, every year it's something, right? It's either a travel story. I mean, my best stories only come, if you noticed, right? My best stories only come from skiing vacations, not from anything else. They're boring.
So here's your sign.
Exactly. They're boring. So, and we just booked our ski trip for this year. So, so guess what? You'll have a story come January. Anyway, good morning, Danny. How are you?
Hey, morning. Good. How are you, Lance?
Good. So a couple of things. I was just talking here about the break, eviction moratoriums, and you understand this, right? I mean, you have a rental property, so
Correct.
This kind of what we always think about with eviction moratoriums is like, okay, great, we're just helping this group of people, and look, I'm not against helping people at all, right? I mean, I think it should be something we all do, and my family's charitable, your family's charitable, we all do these things to help others, and that's part of what makes society better is by
Correct.
individuals helping other individuals. And it's always interesting, we think that if you listen to the media that everybody just hates everybody and nobody does anything, but it's always interesting whenever there's a crisis, you'll see people show up of all races, creeds, religions, etc., to help, right? I mean, it's human nature to do this. And so I get the sentiment that we need to help renters, potentially pay rent, but we forget, and as I was saying at the open, we forget about the landlords, right? And we just assume
Correct.
that these landlords are just a bunch of rich, fat cats, and that's not really the case at all. I mean, how many clients do you have that have rental properties? I mean, it's a lot.
It is a lot, and I think that it's substantial in the sense that many of these people do require this income to live on. We have a lot of people that have moved here from other places. They go buy rental properties, and that's what they depend on to live. And now when you take that source of income away and you don't give them any reprieve, I mean, these guys aren't getting saying, hey, don't worry about it. Don't pay your note for the next so many years or months. That becomes an issue. And so I think it does have that snowball trickle-down effect over time, and that's going to become problematic the longer we see this. But, one thing about the eviction moratorium, this isn't as blanketed as the previous ones.
Right.
This is actually, they're going county by county. And so this will be interesting to see, their definition. What they're saying is this going to apply to counties experiencing substantial and high levels of community transmission levels of COVID-19.
Right.
And counties can come on and off this list at their discretion.
Right. Now, here's what's interesting, though, is that right now, 90% of renters are covered by those counties. So,
Correct.
Great. If you happen to be in the 10%, I mean, they've done this very strategically to make sure to cover as many people as possible. But, this is an interesting thing, though, Danny. I mean, what about, I didn't get a break on paying my mortgage payment, right?
That's right.
Nobody gave us help for, paying mortgage payments or paying, and again, and when we talk about renters, we're talking about people that are renting houses, but what about business owners that have to pay rent for, their restaurants right now, right? So, there's a lot of things that again, kind of filter into this equation that, it's not just helping one group, but whenever you help one group, you wind up hurting another. And the question is just to what extent. And now that we're, in New York as an example, starting to shut down, bars and restaurants again, this is, this is not going to be good economically going forward, which is going to drag this process out further in terms of getting the economy back on its feet.
Yeah, so this is a real clever way of saying, hey, we're not going to shut you down. However, if you don't have your mask, if you don't show your vaccine card, you're not going to be able to come into these establishments. And, we'll see how people react to that, because I think people are becoming a little bit more ornery when it comes to some of these things over time,
Right.
especially as we've let people get back out and now we're telling them, hey, you're going to be shut back in again. It'll be interesting to see how people react to this.
True. So look, a couple of things here though is, kind of as we go forward and kind of looking at, this is, we're about to run up into the final tax paying part of the season. This is where people that did delayed filings for taxes are about to come due September, October. There's, and we've talked before about doing Roth conversions and trying to figure out ways to mitigate tax, potentially in this idea that with all of the spending, that tax rates are going to have to go up at some point.
Correct.
It really doesn't, it doesn't really matter who it is that's going to be in office. Eventually somebody's going to say, look, we have just spent way too much money. We're going to have to raise taxes. Don't really see a way that taxes don't go up at some point. And this is one of the things that we've talked about a lot here on the show, is doing Roth IRA conversions as an example to move those pre-tax dollars that you put in at lower tax rates that will come out being taxed in an IRA situation or a 401k situation down the road, converting that now, paying taxes today at a lower rate, converting that into a Roth so that those payments come out tax-free down the road. But there's some tricks to that, right?
There's a lot of tricks to that. And I think let's take one step back and talk a little bit more about not just what's happening from a tax perspective, but also legislative perspective, in the sense that they are upset. Congress is upset that too many people have too much money in IRAs.
Okay.
And they've created this big wealth gap. So new studies showed that 497 high-income taxpayers had over 150 million in their IRAs. Nearly 25,000 taxpayers had an aggregate of 5 million or more.
Okay.
Now that
which
number
is 1/10 of 1% of the population of IRAs. Got it. I get it.
You
It's
and
the
I
wealth
know
gap.
this.
Yeah.
Yeah.
It sounds like a lot, but it's just the wealth gap. That's all it is.
Well, and this wealth gap that has expanded so significantly. So if we look back to 2011 data, that actually shows that only 8,000 taxpayers had an aggregate balance of more than 5 million. So here's the kicker. Everybody has the exact same rules as far as how much you can invest into an IRA. Regardless if it's traditional, if it's Roth, everybody has same income limitations. Everybody has the same exact amount you can put in. But you've had some people that have obviously been able to use it to their benefit, some in 401ks that they've rolled over to IRAs, others who've used these very, look at Peter Thiel. That's been the big headline. He went out and put PayPal in there when it was worth, pennies on the dollar.
Right.
You have other people who made very smart investments.
He was also one of the original seed investors into PayPal. So that's where a lot of this money was created, was by VCs that were able to buy the seed round of these companies long before they went public.
Absolutely, and stuff that most people, you and I, wouldn't even have access to, right?
Yeah.
But this is a very small percentage of the population. If you think about some of the things that have occurred with all the bailouts, that's only made this problem worse.
Right.
So they're trying to go after people for using the tax code to their advantage and making sound or good investments. I mean, some of these may not have been very sound, or we'd probably have a lot more people with money in it.
But that's also, to your point, though, even with Peter Thiel, right? We hear about the ones that he invested in that made a lot of money. He invested in a lot of these companies that didn't go anywhere. So
correct.
We get the one or two unicorns out of maybe 100 different investments that he made that made up for all the losses in the other ones. But we never talk about that, right?
No, nobody ever talks about the fish they lost, only the ones that they caught, right?
Exactly.
Rarely do you hear about the one that got away. So, I think that just a setup to what we're already seeing and knowing that they're already coming after us for these dollars. And so this is going to be really important, the Roth conversion scenario in many different ways, right? If you were to pass right now, your wife will take over your IRA just as it's their own. But if you have other places that you want these funds to go, children, other family members, you want to leave a legacy, things have changed a little bit. It used to be that they could take these distributions out over their lifespan under the new acts that they've had. We've had the Secure Act, we've had the CARES Act. They've made some changes where now you have to take it within a 10-year time frame. So you could diminish the impact of these dollars over time, because now you may be giving this to your kids who at their peak earnings, increase their tax bill, lower the amount that they actually inherit. You have to get very strategic on how you do this. So we're seeing the Roth conversions can be so much more important, not only from a distribution standpoint for yourself, especially if we're in a lower tax bracket right now and we're going to see higher taxes, which we all suspect we will, but even further on, creating that legacy long term, I think it's extremely important. So interesting. Roth conversions were first allowed in 1998. They then they spiked. 2010, same deal. Now we're seeing it once again. We're seeing another huge spike. I mean, Lance, every single day we're getting calls about Roth conversions.
Right.
And it's almost difficult to do these right now because we're still waiting to see what this tax code looks like, and they continue to promise that it's going to be retroactive. So we could do something that may be counterintuitive right now that, if we wait a little while, we'd be better suited to do.
Right.
And so we're trying to tread lightly in regard to this, but the numbers are showing most of the time that a Roth conversion is going to be a much better thing long term.
Absolutely.
And I think that's one of the things that we're going to have to continue to address it and watch for. But, doing the numbers, I think that, it'll be interesting to see what the Biden administration comes out with this.
Come right back after the break. More with Danny Ratliff and talking about how to make $44 million in the stock market. How to make $19 million in the stock market. That's the story I want to get to. How to make $19 million in the stock market. That, and also coming up, talking a little bit about the stocks that maybe you should think about buying in this kind of new COVID lockdown, shutdown scenario. We'll talk about that with Danny Ratliff right after the break. Don't go away.
Gina works a diner all day, working for her man. She brings home her pay for love.
You're listening to The Real Investment Show.
I want to be the very best, like no one ever was.
And welcome back to the show this morning, 6:33, as we get this Wednesday edition of the show underway with Danny Ratliff. So a couple of things to get into this morning. I got this interesting email yesterday. I get emails all the time from people wanting to get interviewed on the show, and I very rarely do we do interviews, but other than people within our group, right? Danny and Michael and others. But it was interesting because I got this email and he says, "Hey, I'd like to be interviewed by you on your show talking about how I made $19 million in the stock market." And I was like, that might be a pretty interesting story, right? And I said, you have to provide some proof of this. So he sent me his financial statement that for the year showing that he did indeed make $19 million in the stock market. So there's an old story about if you want to invest like Warren Buffett, it's easy. You start out with $1 billion and you go from there, right? So, yeah, the starting balance in the account was $44 million. It did increase by $19 million, but he did make $19 million in the market, right, on $44 million to start with. So it's not nearly as exciting. If the guy started with $100 and made $19 million, that'd be a story, right?
Well, hey, it's a clickbait. All you needed was the headline news, right?
I know, right? It would have been a good story until I actually asked for details, but there you go. Anyway, but talking about investing and making money, of course, this has been, I'm actually about to write a new article here pretty soon. I'm going to actually start on it today. So Bob Farrell was one of the investing legends of Wall Street for decades. Worked at Merrill Lynch, and he has the famous Bob Farrell's 10 investing rules. And these are the 10 investing rules that you should use. And I've written, if you go to our website, realinvestmentadvice.com, and just put Bob Farrell in the search bar, we've printed his rules a couple of times, illustrated them relative to different periods of the markets. And, they're simple rules. Like, investors buy the most at the top and least at the bottom, which is talking about psychology. Bull markets are more fun than bear markets. No kidding, right? These aren't real complex rules, okay? But they're good, solid rules for investing long term. So I'm about to rewrite them for the QE era of the economy. So, for instance, bull markets are more fun because bear markets don't exist anymore. Will be the new rule, right? So I'm going to rewrite all these rules, and we'll put that out in the next couple of weeks. But this is really kind of the point is it really doesn't matter what happens in the markets, that it's always bullish all the time. And, it's interesting if you listen to Jim Cramer as an example on CNBC on a couple of Mondays ago, we had that correction that lasted for a day. And at the end of the day on his show, he says, this correction won't be over till all the speculators are out of the market. The next day, the market rallies back, half of what it loses. He's like, well, the bull market's back. So that's the way this market is, right? I mean, it's very shallow dips, no real concern here, no real fear in the market. Investor allocations are at all-time highs. In fact, investors have never been this long stocks ever before in history. Not at the peak of 99, not at the peak of 2007. Today, more exposure to equity allocations than ever before. And not surprising, right? We've all been taught now QE, et cetera, is the new thing. As long as the Fed's doing QE, stocks can only go up. So having said that, Cramer out yesterday talking about what stocks we should buy in the next lockdown. So Danny, you agree with that, and what stocks are we talking about here?
Well, do you think we should buy these or not? I mean, I think that these could be sound investments either way, but he's talking about the things that did really well previously. Your Targets, your Walmarts, Costco, Amazon, your big box or, your shipping box stores, right? Mm-hmm. FedEx, UPS. And so some of these like Target, he's targeting because, no pun intended, they're having great back to school sales already. We're starting to see numbers from them, increase. We're looking at Amazon, FedEx, UPS, just because of the potential for people being shut back in. We think that'll pick back up. I mean, I don't know. I'm working from home. I see these trucks going up and down the street. I don't know if they've increased or decreased. I think they've continued pretty steady one way or another. And so it's interesting to watch these things occur. And how does this actually play out? Do we see people dive back into those? Because we see this on a daily basis, almost. That rotation happens so quickly. Mm-hmm. From you get your big tech, you get to your companies like these or your large cap values, the inflation to reflation trade. And so you could have almost a knee-jerk reaction with this just based on the headline.
Well, and it's true. And that's people that watch CNBC, he makes these recommendations, they run out and buy them. And so, yeah, you can absolutely see that kind of, knee-jerk reaction just from the recommendations. So, which has always been one of the interesting things about the financial media, as a financial advisor, right, where we're bound by the rules of the SEC, making recommendations can be very risky, right? So if we're on the radio and we're saying, hey, go buy this particular stock, we can be held accountable for making recommendations to individuals without what they call know your client, KYC, the know your client rule, making sure the recommendation is appropriate. But yet every day on the financial media, they just make recommendations all the time, and doesn't matter what the consequences are, right? And again, a lot of people watch CNBC, they take their recommendations from that, and they go make investments. As long as markets are going up, it's great. We just kind of forget about the times that the markets didn't do very well. And those recommendations
that's right.
Didn't do well at all.
And we're not saying these are recommendations by any means.
Exactly.
But, it's interesting. Years ago, there used to be Art Cash. I think he was a UBS floor trader. He's still on CNBC some. I started looking at his headlines, and I would just document because it drove me nuts. Because one day he could tell you to run for the hills. The next day he could say, if you're not all in, you're missing out.
Right.
And I just thought, oh, my gosh, if people were actually listening to these people, think about how detrimental it would be. And man, the whiplash you'd have and the mental fatigue would just be tremendous.
And it happens. I mean, we see this all the time with individuals. But it's interesting, though. The one thing we forget, and look, I agree with your premise, right? And even what Jim Cramer says, right? So, companies like Costco, Walmart, Target, these are good, solid companies. Here's a good example. Yesterday, Clorox reported earnings. And Clorox, we wrote an article. Actually, let me give credit where credit is due. Michael Leibowitz wrote an article about 2 months ago talking about how Clorox was trading 11% above its revenue trend. It corrected yesterday by 11% at the open, right back to its revenue growth trend. So, interestingly enough, I mean, valuations matter. And a lot of these companies, you take a look at a chart of Costco as an example. Costco has had a tremendous run, and full disclosure, we own Costco in our portfolio. But it's had a tremendous run. We bought it, 60% ago. It's up 60%. Did its sales increase by enough to support valuations at 60%? And will sales increase that much more as we go forward? I mean, people are already, shopping at Costco. And again, I talked about Costco the other day, right? We just had to renew our membership, and for renewing our $120 a year membership at Costco, I got a free coffee mug. So, you know, the entire reason to have a membership, coffee mug. But, you know, will they be able to grow sales by that much over the course of the next year, particularly with stimulus now coming out of the system, wage growth slowing back down to normal trends, savings rates coming back down? Are people going to have a lot of excess cash to spend? That's going to be the question, right? And so I think there's a risk to even these companies that, and we just saw this with Amazon, right? Amazon just got cracked the other day by 7% because, you know, estimates didn't quite get there, and outlook wasn't that great, because things are going to start to return back to a normal trend of growth, and that's much lower than what we saw last year because of all the stimulus.
Well, yeah, Amazon though made 113 billion in revenue versus 115. I mean,
Right.
which is a substantial number,
Yeah.
but you know that's a pretty big pullback. But could these be just the stampede? It may not even be the valuations. I mean, we know valuations have been out the window.
Right.
So could it be the stampede of investors hearing the news and thinking, "Oh man, we need to jump in," and everybody's going to the same spot at the same time? Now, at some point you get burned, but until you do, you're going to continue that behavior.
Yeah, exactly. I mean, this is all, but again, this is all Fed, all QE, and I'm writing an article right now. I'll have it out in a couple of weeks probably. I've got articles stacked up till like the end of September. But I'm writing an article right now talking about the three things you need to pay attention to, and one of those, of course, is the Fed taper. I mean, this whole thing, this whole drive of markets has been based upon this flood of liquidity from, you know, the government and the Fed. Well, stimulus is now ending unless we get more, right? That's going to be the question. And at some point, we may start seeing the Fed talk about taper. And when that occurs, valuations don't matter now, but valuations will matter when we start seeing that taper occur. When liquidity starts being extracted from the system, valuations are going to matter, and they'll matter a lot at that point.
Yeah, how quickly will that happen when it occurs? I mean, we've got concerns. Fed Chair Clarita is talking today. You've got Jackson Hole coming up. I mean, there's potentially some things that could pop up pretty quick.
Yeah. Well, and again, you know, the Fed speakers and again, this is something that Mike and I talk about on Thursdays is, you know, you listen to these Fed speakers and you'll get 5 Fed speakers that all say different things. You know, 2 say we're going to taper, 2 say we don't, 1 says I don't know. So, you know, and when you walk away, the markets, you know, just to kind of go back to the fact is, okay, well, there's no taper yet. But, you know, that's all these trial balloons that keep getting floated out. And the important thing to listen to, though, is that we are starting to see more of these balloons getting floated out about tapering. And markets aren't really paying attention to it right now. But these are those tests for the markets. Like, okay, if we taper, you know, is the market going to react really negatively? So, all right, so, you know, Fred, you go out there and say something, and he goes out and says something, and the markets don't do anything, and the Fed goes, okay, well, I guess we can taper a little bit, and markets aren't going to care. They're going to care. They just don't believe you right now that you'll actually taper. That's the problem. Quick break right now. We'll be back after the quick break, picking up with Danny Ratliff. Get ready to close out the show. Hey, what does bicycles and, you know, all these types of social attitudes that we have currently, what does that have in terms of an economic impact going forward? Be right back after we'll talk about it. Don't go away.
You're listening to The Real Investment Show.
A modern day warrior, mean try. Today's Tom Sawyer, mean right.
And welcome back to the show this morning. So, real quick here, just a couple of thoughts this morning as we kind of get the Wednesday show underway. I'm going to throw it back to Danny here. But one thing I was reading over the last couple of days in particular is that, you know, really since about 2008, there's been this slow migration more towards, you know, social equality and acceptance of various sorts of lifestyles, et cetera, in the economy. And the one thing we don't think about is there are economic consequences to all these decisions that we make. And, you know, we don't think about potentially, while we're in the moment and we want to say, great. As an example, same-sex marriage, right? This is great. Everybody should be a same-sex marriage. Okay, let's go with that idea for just a second. So, okay, everybody should be same-sex marriage. That's great. Nothing wrong with that, except for the fact that you have a demographic problem, right? And that has a consequence ultimately on growth rates of economies and everything else, because you've got to produce children in order to support economic growth. And we can't even immigrate fast enough to support the demographic needs in the U.S. right now. We now have less than 2 people paying into, and this is something Danny and Richard talk about all the time. And, I argue with them quite often because they're going, Social Security will be fine. No, it's not. You've got 1.6 people paying in for 16 people taking out. It's not supportable because you don't have the demographic. Right now, we have the lowest birth rate in the U.S. since the 1940s. So, as an example. Other consequences that we talk about. Want to be green. Great, no problem. Let's all be green now. In fact, let's just get rid of driving cars and let's all ride bikes, right? Let's go to the extreme end of this measure, right? Sounds great, right? We're going to be super clean. Everybody's going to ride a bike to work. That's not really going to work well in Houston or Austin. Too many hills in Austin and too big in Houston.
And you need a shower when you get there.
And you'll need a shower when you get there, especially in August. But let's all ride our bike to work. Okay, great. But we don't think about that. Sounds great on the surface, and let's all move in that direction. Let's get rid of cars altogether. But now we don't, pay for insurance. We don't buy cars. We don't, pay for gas, which doesn't pay the taxes to support our roads, which is also the problem with electric vehicles because you don't pay for gas taxes. You don't pay for paid parking, right? All these paid parking garages. You don't have serious accidents, which lead to repairs and maintenance. There's all these other consequences economically that occur from decisions. And so the one thing that we have to, and again, there's nothing wrong with making decisions to have a better environment, right? We should all want to have a cleaner, better environment. There's nothing wrong with those decisions, except we need to think about the consequences that those decisions ultimately have on economic growth and make sure that we are matching those decisions relative to the expectations of the impact on economic growth longer term. And we keep forgetting about those things. And we make these rash decisions to make major changes, and then we fund it with debt. As an example, coming up with this new $3.5–4 trillion, whatever it turns out to be, American Rescue Plan, we're going to have massive spending into electric vehicles and infrastructure and human infrastructure and all this type of stuff, all funded by debt. 100% of that's going to be funded by debt that taxpayers have to pay for. Well, where do the taxpayer dollars come from in order to pay for that debt? Well, it comes from the economy. If you don't have a strong economic growth, you don't raise the tax dollars, your debt service requires even more. You've got to issue more debt, and it's a spiral you don't get out of. Now, when does it end? Who knows? GDP, Japan's been doing this for 30 years now. Their GDP hasn't grown in 20. Economic viability in Japan is the worst it's ever been. And they're 230% of debt to GDP. So everybody says, well, look, it doesn't matter really. They haven't completely collapsed yet. Well, yeah, but do you really want to live in that economy, right? It's not a great environment, especially for younger people. And this is why we keep getting rising calls for socialism. So it's just something to think about as we talk about and as we hear more about the upcoming American Rescue Plan, the money we're going to spend, how we're going to spend it. There's a consequence to that longer term. And all these decisions that we make, right, and whether you agree with them or not is irrelevant. It doesn't matter whether you agree with decisions being made from everything from social justice to climate change. Doesn't matter what your personal opinion is. The impact that you need to be thinking about, whether you agree with it or not, is what is the economic impact long term, because that's the effect on your outcome, personal income, not my income, not Danny's income. It's your personal outcome that you're talking about. So again, just something to think about as we make all these decisions, because the speed of these decisions are now increasing at a more rapid pace every single day. I mean, as we started out, the eviction moratorium is a great example of this. We're going to bail out a small group of 11 million renters. We're going to bail them out. Okay. 11 million out of 330 million people, no big deal, right? Small fraction of the population. It's not just 11 million people. It's 11 million renters, and then all the individual people that actually own those rental properties that were depending on that income that you just took money away from, right? So it's not a net sum zero game. And that's the thing that our politicians keep forgetting, and that we don't do enough work on thinking about how to balance those effects. In other words, hey, we're going to, you want to solve the problem with the renters? Okay, renters, you don't have to pay rent. But if you're a landlord, you don't have to pay your mortgage payment, your taxes, nothing, right? You don't have to pay anything on the house. They don't have to do anything. In fact, you don't even have to maintain the house. If they want to live in it and have grass grow to the roof, that's their choice now. They can mow the yard if they want. You know, but make it balanced, make it even. But see, we can't do that because now the banks go, hey, wait a minute. I want my mortgage payment. They can deal with the rent payment. I want my mortgage payment. See, it's not quite the way we think it is. Anyway, Danny, sorry, just jumped me off on a rail there for a second. So we lost Danny. He's muted again. So
Nope, I'm back.
There you are.
Don't worry. You know, technical difficulty seems to be par for the course some days, but you know, those are all really good points, Lance. And some of those things you mentioned, obviously, you know, there's a feeling that they are very inflationary, and we're seeing inflation. They're hitting people's pockets daily. You know, so what do you think about like holding gold or gold equities within a portfolio? We're getting some questions on that on the YouTube channel.
yeah, no, you know, it's interesting. I actually had another article in my hopper. Actually, I have it out, I think on Monday, maybe, talking about what's wrong with gold. Gold is not performing. And in fact, there's a very big, you know, deviation between inflation and gold prices. And if we look back through history, one of the caveats has always been is that gold is a great hedge for inflation. It's kind of true. It's kind of not. This is one of the times that it's kind of not. When was the other time that it kind of wasn't? From 1980 to 2000, gold vastly underperformed inflation and financial markets. So there's nothing wrong with owning gold. And the real problem with gold became when we came off the gold standard. So there's no longer a linkage between the currency and gold. You know, used to back in the day, if I had a dollar bill, I could go to the bank and I could change it for a dollar's worth of gold at the bank. And I could just say, hey, give me gold. And they would give me gold in exchange for a dollar. You can't do that anymore. And unless you've got a really smart barista at Starbucks, you can't buy a cup of coffee with a gold coin, right? If you go, I mean, or gold nugget, sorry, not coin, probably could with a coin. But with a gold, you walk in with a gold nugget, hand it to the guy behind the counter. He's going to look at it and go, this is cool, but I need $5.25, please, in green. Give me your debit card. You know, it's not a means of currency at this point any longer, which causes it to detach from what happens in the underlying economy. So right now, gold is not a good place to be on a short-term basis. Inflation is outperforming. The only thing that's really outperforming inflation right now, unfortunately, is equities. And so we need to have more exposure to equities to make sure our capital is outperforming equity growth. Now, inflationary growth. Is that going to always be the case? No, it won't be. And there will be a point that gold does very well relative to a declining stock market. We're not there yet. And what causes that, and this is the whole point of the article, is what's wrong with gold? Nothing, except the fact you have no fear in the markets. And gold is, and again, going back to the idea that gold is not linked to currency anymore, it is now linked to fear. And there is a good correlation between gold and fear in the markets. So when you start getting real fear in the markets, gold tends to outperform much better. In fact, gold did well during the early phases of the lockdown. It hasn't done so much ever since we came, you know, into this idea that, you know, QE forever and financial markets only go up. You know, once we adopted that idea, gold is no longer a fear trade because there absolutely is no fear in the markets. So again, it's should you own gold? You know, we own gold in our portfolios from time to time. I have, you know, some, you know, physical gold in collectible coins. And my personal view about owning gold is I wouldn't own, you know, bullion as a function because it is solely tied to the price of the market. Own coins, gold coins with numismatic value because numismatic value will always have value, right? If it's a collectible piece, then that collectible value can exceed the value of the underlying metal and hold value better than just the pure underlying metal itself. So, select how you're going to hold physical gold if you're going to do it. If you're not going to hold physical gold, then just use gold as a hedge against fear in portfolios. So there's the short, long version of a quick answer.
Oh boy, you'll be getting some hate mail from this one.
No, I'm not saying you shouldn't do it. I'm saying you just be careful how you do it. That's it, right? So, all right, thanks,
well,
Dan. Go ahead.
I know we're short on time, but tomorrow maybe talk a little bit about the inflation trade. A lot of people looking at tips versus equities.
Yeah.
How that may not work out for them.
Yeah, we'll definitely talk about that because that's all being driven by the Fed right now. So, but we'll get with that with Michael Leibowitz tomorrow as well. Be sure by the website, realinvestmentadvice.com. Send us your questions, comments, hate mail. Always there for you. Realinvestmentadvice.com. Just click the Ask a Question button. Address all hate mail to Danny Ratliff. I'll make sure he gets it for you. And, of course, get our latest videos, posts, and more on the website. Realinvestmentadvice.com. Have a great Wednesday. See you tomorrow.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich